Hello, everyone. Mike here, and I thought I would share a message for you. Here we are in February, so the market's been a little less than cooperative as we started the year. And I know some of you have wondered, hey, my accounts are going down a little bit. What's going on with the markets? Is it anything to be worried about? And I'll tell you this, I don't see anything that you should be worried about at this point. But I thought, what the heck, let's kind of go over what's happened so far this year and what's affecting markets and what are some of the things we have to pay attention to. So right here on the screen, you see the S&P 500, which is basically the stock market. And it opened the year around, 47, 4,800, and it went right out of the gates, went down about 10%. So markets were down 10% in the first month of the year. You're like, oh man, that's not a good thing. Now, since then, you can kind of see down here, they're down about 10. They've kind of come back a bit, but so far year to date, they're down 4 or 5%. As I've been having review meetings with a number of you, we're seeing that your accounts are down maybe 2% or 3%, which is exactly what you want to see. We know that when markets go down, we're going to go down a little bit, right? But we don't want to go down to the same degree that the markets are. And for most of you, as I said, it's been right around the 2-3% mark. It's normal. You see this. It's okay. That's just kind of how it goes. Now, if you're in more growth-focused accounts, those accounts might be down a little bit more. But there you go. I mean, year to date, we're only down about 4%. This is not any reason to be concerned. You always want to watch out when you have these double-digit drops. In my view, this is one of those, usually about once a year, historically, once a year on average, we get this, right? We get this drop of roughly 10% at some stage. And this year, we just kind of started the year out with it, but we'll see what happens. Now, what's driving some of this? Because I know in the news, a lot of people are worried about inflation and rising interest rates that the Fed has talked about. And yes, those are certainly components. But in all honesty, everybody knew about that stuff coming up already when we entered the year. So that the fact that inflation is kind of out there again, and the fact that the Fed's going to raise interest rates, we already knew that. So that it's not information that drives the market. It's information you don't know. And so what was happening at the first of the year? Well, it was this, right? It was Russia suddenly deciding, hey, maybe we're going to invade the Ukraine, and there'd be some unrest in that part of the world. And more importantly, if that's all it were, like one country going after another country, that's on its own not that big of a deal. It's happening all over the world at different places. But in this case, Russia, one of the big oil producers in the world, if Russia and Ukraine start, fighting it out, if you were, that's going to affect oil. And that's going to create some unrest in the world. And that, of course, makes markets react in a negative way. Oil prices, who knows what would happen? Russia invades, there's oil embargoes, who knows what happens, but probably price of oil goes up even higher, which means the price at the gas pump goes up more, etc. Right? So let's, that I think is what drove markets earlier in the year, although now what's happening is that drove us going down, but now what's happening? Why are markets going back up? Because this Russia thing's still going on. Hey, it's earnings season, and all these companies are coming out reporting ridiculously good earnings. So everybody's like, oh, wow, these companies are still making money. They're projected to still make a bunch of money. I guess things are okay. And the markets are saying, all right, we'll cooperate and move up for a while. It's just kind of how the world works, right? So anyway, we want to keep our eyes on Ukraine and Russia and what's going on there. That will, if something happens, it'll unsettle markets, I would guess. But at the same time, you're all positioned in a manner that protects you from too much downward volatility. Couple things I do want to spend a few minutes talking about, though, are inflation and what the Fed's doing and how that's impacting a lot of other things. So a lot of you know this. If you've been to the supermarket and tried to buy a steak or something, you know this, but the January consumer inflation is expected to rise by 7.2%. That's the highest since 1982. And it's interesting because I've been talking for a few years about, people are saying, Mike, if there's one thing that worries you, what is it? And I've said for a while, I've said, I think it's inflation. We got to watch out for that because, for the longest time, inflation has been almost a non-measurable number. It's been so low. But the world goes in cycles. And, we haven't had inflation for so long, you just know it's going to come back at some point. And here we have inflation. And really the big concern is not what this number is right now. That's not the big concern. The big concern is this a sustainable number? Is it going to continue? Or is this kind of a blip due to the coronavirus and shrinking the supply chain? Is it just kind of a temporary blip? Everything we're looking at right now would indicate that it's more of a temporary blip. But with that being said, you never know, right? So this is something we do want to pay attention to. Now, why do we really have inflation right now? So everybody's blaming coronavirus. Everybody's saying, oh, it's a supply chain. I would say, yeah, it might be the supply chain, but I think there is maybe a different source of inflation. I think there's something else going on that we don't spend enough time talking about. It's right here. This is from the Fed. This is the money supply. This is how much money is circulating around our country. And notice, in 2008, it jumped up and we're like, oh my gosh, look how bad that was at the time. But since then, we've just dwarfed it. Look what happened in 2020. Coronavirus hit. We went from, $4 trillion of money out there. And in a very short period, we jumped up to 16 trillion. It's like 4 times. The amount of money circulating in the system went up 4 times in just a few months. And now it's up over 20 trillion. So it's up 5 times from this point. So from the moment coronavirus hit to today, our money supply is up by 5 times. Of course, there's going to be inflation. Even Homer Simpson would say dole. I mean, even he gets that. Obviously, there's going to be inflation when you're printing money left and right to keep the economy moving. And that's, I think, more than anything else, I think that's what's driving inflation right now. But what is the Fed going to do now to fight this? They're saying, what does the Fed do? They're saying, we've done all this. Because this is the Fed doing this, printing money, buying up bonds or buying a debt from a number of places. This is the Fed going crazy, just throwing money into the system to try to keep our economy rolling, right? So, and by the way, this is part of what fuels the stock market going up too, because suddenly a dollar's worth less. So what's the Fed going to do about it? They say, inflation's finally coming. We got to do something. So what are they going to do? They have announced, basically they said, we're going to increase interest rates 3 times this year. We're going to try to get the Fed funds rate, it's called, up from what was essentially 0 up to maybe 1%. Starting in March is going to be the first one. And here's the other thing. Their asset purchases are likely to halt in March, which is asset purchases are basically them buying up debt from banks and other companies. The point is the Fed is saying, all right, we did this, right? Now it's time to maybe stop doing so much of that so that we can get inflation more in control. So, we're all blaming the supply chain. I think this is probably more likely than the fact that, car companies can't get a chip for their car, right? What I do, though, want to take a couple minutes, though, before we wrap up today talking about is, how does this really affect you? Well, I think this is a fun little chart. This is the value of a dollar since 1913, like over the past 100 years, basically. And what's kind of interesting is $100 back in 1913, when the Fed was created, is worth $3.87 today. In other words, about 25 times less. And that's just continuing. Your dollar is getting less and less valuable over time. And you know that, right? You know that you can't keep too much money at the bank because it's going broke safely. A dollar, you have $100 at the bank today, $100 at the bank a year from now is not worth as much. And it's just continuing to be worth less and less. So you want to be smart about how you're strategically structuring your investments to help protect against things like that. But why, by the way, for what it's worth, the government actually kind of likes this. And you're like, why would the government like that? Why is the government fans of inflation? Why is the government fans of the dollar being worth less? Well, it has to do with this right here. This is usdebtclock.org, fun website to go to periodically. Notice that our national debt right now has crossed the $30 trillion mark. Now, it's almost impossible to visualize how big of a number that is. $1 trillion is, I think the math is, and by the way, don't hold me to this, but I heard this the other day. Let's imagine that someone gave you, or that you gave the government $1 trillion on the day Jesus was born. And then every day thereafter, you were given back, you give the government $1 trillion, and every day from the day Jesus was born, they give you $1 million, $1 million, $1 million, $1 million, $1 million a day. A day. How long would it have taken to pay off that $1 trillion? Well, here we are today. Congratulations. There's still something like $859 billion left to pay or something. I mean, it's just like, it's a ridiculous number. It's so difficult to capture. But what I like about US Debt Clock is they say, hey, how much is that per citizen in the country? It's about $90,000. Does every citizen in this country have $90,000 laying around to pay off the national debt? Not a chance. But if there's inflation and your dollar is worth less over time, guess what? If they could make the value of the dollar cut in half over the next 5 to 10 years, guess what? Now it's only $45,000 per person in today's dollars, right? So essentially, inflation helps the government address this number to some degree. Now, with that being said, if interest rates rise too much, they're borrowing money. That could create some problems with all of this. But at the end of the day, just be aware that raising taxes, how do they get this addressed? They have to raise taxes, reduce the value of the dollar. And, the third thing the government could do, I guess, is maybe spend less money. But I think we can all agree that that's not a realistic assumption. I don't see the government thinking, oh, maybe we should, actually growing up and being financially mature and saying, oh, maybe we should spend less money. I don't see that happening. I think much more likely they're going to increase taxes and help maybe drive some more inflation to help with these numbers. But there you go. One thing I will tell you, as the dollar, how does all this impact markets? As the dollar becomes less valuable, markets will continue to rise because, what's the price of a stock? If it's worth $100 today, but a dollar's worth half of that in 5 years, then it's worth $200 tomorrow. So stocks are one way to help protect against inflation. Real estate is another way, and by the way, gold, maybe for what it's worth, I think we're starting to see the rise of things like Bitcoin, Ethereum, crypto assets starting to replace gold in our economy. But, we'll see where that goes. All right, that's our message today. I hope you found it helpful. Just a quick recap. Yeah, markets have started off poorly. They're coming back. I think this is one of those natural 10% dips that we see in markets, once or twice a year. And in your portfolios, you're not going down like the markets are, just maybe a fraction of what they're doing, and that means that portfolios are doing their job. If you have any questions, you can always reach out to us. Good to see you. I hope you enjoyed today's discussion.